past 4 years, consumer prices are up 18.1%, but that doesn't even tell half of the story. Gas prices alone over the past 4 years are up 57.5%. Food services are up 25.3%. Household appliance repairs are up 42%. Vet and pet services are up 33%. Auto maintenance and repairs are up 33%. Tenant rent is up 22.6%. Housing and utilities is up 22.5%. And health insurance is up 21.4%. All of those items have gone up significantly in price, and all of those items directly impact the pockets of American consumers. Stack on top of that the fact that the government this year is going to spend more than $1 trillion servicing its own debt. This is $1 trillion that the government is going to print to pay off its debt. This $1 trillion also exceeds the amount of money our government is going to spend on defense purposes this year. All of this leads to a very murky picture for the economy and the stock market, and it really has led to an uproar, an uprising of financial YouTubers and pundits and CNBC contributors and influencers on social media that have been predicting a recession and have, I think the most popular video title has been "Things Are Breaking" for the past 4 years, yet things just simply aren't breaking. Now, in today's video, this is what we're going to be discussing. We're going to be going through my thesis of how and when the stock market will actually crash. And to really analyze this, we're going to be discussing what the bears have gotten wrong for the last 2 or 3 years, and also the 6 different items that have caused recessions and bear markets in the past. And ultimately, we're going to end up at a place where I give you my thesis on how this is going to play out, because everybody understands a stock market that is in a euphoric state won't stay euphoric forever. But I really want you guys' opinions and feedback on this video. This video is going to be a little bit different than what I normally put out there because we're going to get pretty granular. And a lot of times when I get granular, we kind of lose people along the way. So let me know after you watch this video, your thoughts on this, how I can improve it. I want to know everything. If you disagree, agree with my thesis, let me know down in the comment section down below. And if you're new here or turning not yet subscribed, please subscribe down below. It's totally free and it helps my channel out tremendously. Without further ado, let's discuss this. In my opinion, the big mistake that the bears and these doomsday YouTubers have been making is they're doing technical analysis of macroeconomic data, where they find causal effects and correlations that have occurred in previous Fed tightening cycles, and because they flashed red previously and a recession followed those flashing red signals, they think it has to happen again. And if they flash now, that a recession is inevitable because it occurred previously. But what that ignores is the major structural shifts our economy has seen since the 1950s. And even just post-pandemic, how different our economy is now. One of the major long-term structural shifts we've seen in our economy is simply the shift away from being a goods-producing country to being a services-producing country. Just to give you some evidence of this, in the early 1950s, goods production made up 50% of what was produced in America. Today, that's down to 31%, whereas with services back in the early 1950s, services only made up 40% of what was produced in America, and that has risen to 61% today. And if we want to dumb this down even further, we can just look at it as a percent of total consumption. Spending on goods has fallen from 60% to 33% of total consumption in our country, and spending on services has increased from under 40% of our total consumption to over 68% of our total consumption. So what's the big deal with this? Well, this tells us that our country is far less dependent on interest rates than it was previously. On one hand, producing goods is extremely capital intensive. It requires lots of financing to even just get started producing goods and build those manufacturing plants, and then their profit margins are much thinner than that of the services companies. Our economy today is much more controlled by the services and tech companies that have much higher profit margins and much higher cash flows, and also much less debt than the goods producing companies. In fact, today, most of America's goods consumption is attributable to imports from China, for example. We can actually see this on the chart here, where manufacturing capacity and output has been flat since China joined the World Trade Organization in late 2021. So the point in saying all of this is the fact that as a result of the shift from a goods-centered to a services-centered economy has happened, our reliance and sensitivity to interest rates has really decreased as a result of the higher profit margins and less debt and less startup capital needed and startup financing needed to start a services-based business versus that of a goods-based business. And then the more recent structural change of our economy has actually come post-pandemic, where we had a large swath of baby boomers retire and stay retired, which left open a lot of jobs for the younger generations, which have been getting filled by the younger generations. But more importantly, the baby boomers, which are all at retirement age now or older, they have a record $78.6 trillion of net worth. These retiring baby boomers have been spending mightily on healthcare, leisure, and hospitality. And if we look at the employment numbers in those sectors, you can see that employment has been boosted tremendously as a result of this spend. And the only thing the pandemic did was make baby boomers have even more of an itch to spend their money and to spend their net worth. So this demographic shift is something that the bears and doomsdayers just have kind of ignored or completely missed as a whole. But the soaring services spending from simply the baby boomers at restaurants and healthcare facilities and airlines and hotels has boosted demand for workers in those areas, which is part of the reason our labor market remains very, very strong. In fact, a record 22.3 million Americans are employed in healthcare and social assistance. Another 17 million are employed in leisure and hospitality, and another 23 million work for the government, mostly state and local. And in contrast, if we combine all of the goods-producing sectors of our economy, it only employs 22 million people total, constituting only about 10% of payroll employment today, which is down from 30% in the 1950s. And it is kind of funny, the bears and doomsdayers' original argument was that the Fed was going to have to raise rates rapidly to force a recession to tame down inflation. Now all of a sudden that argument has changed to the Fed's going to have to cut rates super fast in order to avert a recession. It's just crazy how overnight that argument has shifted and really kind of flipped on its head. And I'll even say this, the bulls right now are very mistaken in my personal opinion, where they believe in order for the stock market bull rally to continue, we have to see interest rate cuts. For me, I don't believe this at all. I still see no reason for the Fed to cut interest rates. Our economy is performing admirably. The Atlanta Fed's GDP tracking model shows real GDP tracking to grow 3.1% in Q2 of 2024. That is incredible. And actually, I think it's better for the bulls the longer it takes the Fed to actually cut rates. That might sound backwards in some of your heads, but think about it. When the markets are thinking and questioning, when is the Fed going to cut rates? That is a very bullish mindset and mentality. And as long as that's the mentality of the markets, you're going to see buyers outweigh the sellers. And eventually that mentality is going to shift to, are we going to get any more rate cuts? And that, my friends, is a much more bearish mentality for the markets. But the only time that that shift can take place is after the Fed actually cuts rates. So the longer the Fed holds off, the healthier it is for this bull market, in my personal opinion. The current bullish mentality actually has a name. It's called the Fed put, where basically the markets enter euphoric stages because the Fed just will simply cut rates to avert a recession. So it dramatically decreases the likelihood we will see a recession. And as a result, it decreases the likelihood we will see a bear market, which means investors continue to buy and buy and buy because the risk of it is very, very minimal. Now, a lot of you might not like to hear what I'm about to say, but positive forward earnings in the S&P 500 usually get walloped during recessions. And that is far from what's happening today. Forward earnings are actually soaring, and when forward earnings estimates of the S&P 500 soar, it usually happens during economic recoveries, and that's what it's doing now. So this chart suggests that we're actually early in this bull market, and it has a ways to go, which even hearing myself say that kind of scares me. The reason this scares me, and this kind of gives you a hint at where I'm going with when the markets will crash and how they will crash, but the reason this scares me is if the Fed makes a mistake and they act prematurely before inflation is truly defeated for good, they risk fueling a stock market melt-up, which could already be underway. A stock market melt-up creates an asset bubble, which can lead to renewed price inflation. And ultimately, the biggest point here is all market melt-ups lead to market meltdowns at some point in time when the bubble bursts. Now, I do have to give it to the bears. What they were thinking over the past couple of years wasn't completely blindsided. What they believed was that because previous Fed tightening cycles caused financial crises that eventually turned into economy-wide credit crunches and thus turned into a recession, it would happen again this time. They got it right in that we would see a financial crisis. Think back to March of 2023. We had 3 banks, if I remember correctly, go under. But this is another structural shift that we've seen, this time out of the Federal Reserve. Post-Great Financial Crisis, and especially post-pandemic, the Fed has gotten really good at learning how to play whack-a-mole with all of these financial crises that rear their ugly heads. All they do is they throw money at it and it fixes the problem. The small banking crisis in March of 2023 was contained as a result of the Federal Reserve learning from the Great Financial Crisis and the Great Virus Crisis, learning how to effectively contain these problems by playing whack-a-mole and throwing money at these problems. Does the government and does the Fed print too much money? Absolutely. I think everybody agrees on that point, but as long as the government and the Fed is printing money, it's going to be really hard to see a market crash or a bear market. Now, the risk here, and it goes into my market melt-up theory, is if the Fed misidentifies a crisis in the system, where they throw money and liquidity at the system when we don't need it. That's when you would form an asset bubble, and we are especially susceptible to doing so today when you think about basically any asset out there. Housing, land, gold, Bitcoin, the list goes on and on and on. All of those assets are already at all-time highs. And if the Fed throws money at a problem that doesn't exist, we really do risk fueling this market melt-up, forming an asset bubble, and causing a major fallout at some point in the future. Now, going back to what the bears and the doomsdayers have gotten wrong, one of the first things they started pointing to was leading economic indicators, which historically have been pretty accurate at anticipating recessions. But again, this time, it's not happening. The leading economic indicators have been plunging since they peaked during December of 2021. It's down more than 14% since then through May of this year, whereas coincident economic indicators have been rising to record highs every single month. It's very rare we see this negative correlation between the two indicators, but there's a very good reason for it that the bears either don't want to pay attention to or just are flat out ignoring. As I mentioned previously, our economy has shifted tremendously away from goods production and consumption to services production and consumption. And the LEI is kind of at risk of that because 5 of the 10 components that make up the LEI, or the leading economic indicators, are manufacturing and construction related. So as a result, the LEI is a very highly correlated measure with the goods sector of our economy, which obviously the goods sector of our economy has been going through a rolling recession. So historically, I can't blame the bears. The LEI was a very accurate predictor of economic conditions, but back when the goods sector of our economy mattered much more to our economy than it does today. And when it came to the bears' thesis that the Fed would have to engineer a recession to tame down inflation, the doomsdayers missed an important point, and that was the fact that China was going through a property-led recession. And anytime China's economy goes into recession, they try and export their way out of that recession, which means that they're going to flood the world economy with goods that are produced in China. As a result of this, we can see in the data, in the United States, the core goods CPI fell 1.7% year over year in May from a peak of 12.5% in February of 2022. Contributing significantly to that was a 2% drop in import prices from China as they tried to export their way out of recession. Literally, China's economy was exporting deflation directly into the United States economy, which means that China actually helped the United States get through this horrible bout of inflation, and the Fed didn't have to manufacture a recession to bring inflation down. Other countries around the world did it for us. And then we have the inverted yield curve. After the LEI, the bears started to point to the inverted yield curve, which historically has been a very accurate predictor of recessions, with only a few false positives in its history. But believe it or not, the inverted yield curve is actually another component of the leading economic indicators. And as I've said repeatedly in this video, the LEI has become increasingly misleading about our economy as our economy has turned way less industrial and much more digital. The yield curve inverted way back in November of 2022, and yet we still have yet to see a real recession take place. In the past, the yield curve has typically inverted as the Fed hiked short-term rates to combat inflation, while investors piled into the long-term bonds. Investors anticipated something breaking in the economy or the financial system, which would spark a credit crunch and result in a full-blown recession. As a result, investors opt to lock in higher long-term risk-free rates before the Fed is forced to cut the federal funds rate swiftly to revive the economy out of recession. I've discussed it already, but a lot of the reason the yield curve inversion has been inaccurate this time around is because the Fed learned from the great financial crisis and the great virus crisis how to contain different crises that pop up and prevent them from becoming credit crunches and thus resulting in a full-blown recession. The Fed has gotten great at containing these crises and keeping them crises without creating a huge credit crunch. If you ask me, I think the yield curve is going to be inverted for a record amount of time this time around because the odds of the yield curve uninverting, I guess is how you would say it, are very low. There's no reason for the yield curve to normalize without the Fed cutting interest rates significantly. If the yield curve were to uninvert, you would have to have a surge in long-term treasury yields in the 10-year treasury, which is very unlikely to happen. We saw the 10-year yield surge to 5% last year, and Janet Yellen came out extremely fast and shut that down pretty quickly by shifting the government's debt issuance plans to mostly short-term treasury bills rather than treasury notes and bonds and the longer end of the spectrum. Now, next on the list, most of the bears haven't gotten here yet, but I can guarantee you this is going to be their next big point. They're going to point to this Sahm Rule, which historically has also been pretty accurate at anticipating recessions. It only has a few false positives in its past, but again, I think it's going to show another false positive. This Sahm Rule suggests that a recession is either already here or it's on its way if the 3-month average unemployment rate rises 0.5 percentage points above the low water mark of the past 12 months. And as of May, the Sahm Rule was at 0.4 percentage points. And if in June the unemployment rate rises from 4.0% to 4.1%, this Sahm Rule will be triggered and flashing red lights and red signals that a recession is here or it's imminent. Now, my issues with the Sahm Rule are, A, it seems very unprofessional and probably inaccurate to use simple moving averages to make economic forecasts. The reason that seems silly to me is because there are different variables at play during every single macro environment, every single macroeconomic cycle. And if you really think about it, all that the Sahm Rule is telling us is that when unemployment has spiked in the past, it was preceded by an initial rise in unemployment, which seems pretty obvious to me. And yes, while it's true the labor market has softened somewhat, it's more than likely just normalizing. It's really important to consider the nature of upticks in unemployment. Like, for example, during May, much of the uptick came from younger Americans, many of whom are still in college and are off for the summer. And you can see that on this chart. Most of the unemployment comes from people aged 16 to 24 years old. And when it comes to 25 to 54-year-olds, the unemployment rate is still at a record low of 3.3%. And then if you go to 55 years and older, that unemployment rate is at 2.7%. And you can see, based on any data you look at, although the labor market is softening, it's still very strong. Lots of small businesses are still struggling to fill open jobs, and less than 14% of surveyed consumers are saying it's hard to find a job or get a job at the moment. And then you consider immigration. Regardless of what side you're on politically, immigration will likely continue to put negative pressure on the unemployment rate, even as employed workers continue to see real wage gains. Now, I kind of get it. The reason we have so many bears and doomsday YouTubers out there is because nobody's going to click on a video telling you the stock market's in really good shape right now. Everybody is going to click on that video that says the stock market's in bad shape and we're about to enter a recession or a bear market. There's this fascination everywhere with correctly forecasting a recession that very few see coming. In fact, most of the people that do forecast such recessions end up becoming famous. Think of Michael Burry, for example. So there's always going to be that inherent nature for people to want to correctly predict a market downturn. But let's discuss this. There are 6 things historically that have caused recessions in bear markets, and it's pretty much a guarantee that one of these 6 is going to cause the next recession or bear market. The first one we've kind of already talked about. It is the tightening of monetary policy, where usually the Fed becomes concerned about CPI. And along the way, the yield curve inverts, signaling that investors are starting to buy bonds on their expectations that something will break in the financial system. And usually, historically, investors have been right, and the resulting financial crisis has quickly morphed into an economy-wide credit crunch, and borrowers with good credit histories found it hard to borrow, and the credit crunch would then cause a recession. The reason I don't see this outcome as very likely is for reasons I've already discussed. The Fed has learned how to contain these crisis events. Also, our economy, as a result of shifting away from a goods-centric economy to a services-centric economy, relies much less on interest rates. It's impacted much less by interest rates, if that makes sense, both businesses and consumer-wise. So other than the tightening of monetary policy flushing some excess out of the system, I just see it as very unlikely that this will be the reason we see the next recession or bear market. The second trigger historically has been geopolitical tensions and conflicts, which obviously can trigger recessions if they cause the price of crude oil to soar. Now, it's kind of interesting. Geopolitically, we have a lot of tension, we have a lot of conflict, but the price of oil really hasn't gone up that much. This one I view as much more likely to cause our next recession or bear market, but I still see it as very unlikely. Historically, this happened during the 2 energy shocks of the 1970s. It then happened again in 1990 when Iraq invaded Kuwait. And then during the Great Financial Crisis, the price of oil went to almost $150 per barrel. It wasn't likely the cause of that recession, but it likely made that recession worse. Then the third most common trigger is what I believe we're headed towards. It's where speculative asset bubbles form, which end up causing recessions when the bubbles burst. Much of the recession at the start of the 2000s was attributable to this factor alone when the tech bubble of the 1990s finally burst, resulting in the tech wreck. I myself, I have to admit, I'm not old enough to remember it. I'm only 23 years old. I was born in 2001, but speculative bubbles also formed in commercial and then residential real estate during 1990, as well as the great financial crisis in 2007 and 2008, both times resulting in recessions. I believe this is most likely to occur. If you've been a part of the stock market recently, you would know that this stock market rally has been pretty narrow. Throughout the last half year or so, it's really been the Magnificent Seven that has led to a significant rise in the overall market indices. We have Nvidia that year to date is up 155%. Netflix is up 41%. Meta's up 40%. The list goes on and on and on. You can look at the chart there. There's really only been one name, and that's Tesla, that's been down. But more recently, the outperformance seems to be narrowing to the Magnificent One, which is Nvidia. Specifically in the most recent days, the S&P 500 has been rising to new all-time highs, but the percentage of S&P 500 companies trading above their 200-day moving average has been falling. You already heard me say I'm not a big fan of using averages to tell you things, but this one historically is a bit different. Whenever stock market rallies get extremely narrow, it tends to be more towards the end of that rally than the beginning. But again, there's been false positives in the past, and ultimately, if we do see this melt up in the stock market, you're going to be surprised how high Nvidia stock can go. If we look at this chart on the screen here, we can see how the stock prices of the S&P 500 semiconductors have performed, and also the stock price of Nvidia has performed since the release of ChatGPT on November 30th of 2022. These have gone up in literally a straight line. When ChatGPT was released, Nvidia was down for the year pretty significantly, trading at basically $100 per share. And as of when this chart was made, Nvidia's stock price was $1,037. So in about a year and a half, Nvidia's stock price has basically 10x'd. So the question then is, all right, when does this end? Well, this is going to be an unpopular opinion. I think this could go on for a very long amount of time, especially if the Fed does cut rates for God knows what reason. This melt-up could last quite a while, and we could all get rich short term. The problem would be the fallout afterwards. But my thesis here is Nvidia's business actually isn't as healthy as it appears on paper. If you look at Nvidia's largest customers, so the customers that make up the bulk of their revenue, it goes something like this. It's Microsoft, Meta, Tesla, Google, Apple even. Most of those companies that I just named are trying to do this whole data center thing themselves. They're trying to produce their own GPUs, which means this year, 2024, is probably when Nvidia's bulk sales increases year over year is going to take place. Which means that sequentially, as we move into year-over-year comparisons in 2025, they're going to be really tough comparisons. These big tech companies really put the pedal to the metal all of a sudden, spent hundreds of billions of dollars on GPUs and on AI and high-performance computing. That sort of spend, that immediate buying pressure, is going to level off, which has a couple of consequences, maybe the biggest one being Nvidia's GPUs aren't going to sell at $40,000 per GPU forever. Eventually, competition is either going to come into this space, or these companies, like they're trying to do, are going to do it themselves, which means that Nvidia's growth in volume sold year over year is going to come under significant pressure, and also their revenue per unit sold is going to come under significant pressure. The business dynamics at Nvidia really don't look as good to me, or looking 12 to 16 months out as some people think. If you want more evidence of this, you can actually look at where Nvidia is investing its money right now. They're investing into companies like CoreWeave, who is a data center business, who is not threatening to do all of this themselves, who will be an Nvidia customer long term. Nvidia is investing in these startup data center providers, hoping that by financing them short term, these companies can be their long-term customers, that they can make it through this. and they can be their long-term customers and make them money long-term. Nvidia is giving these companies hundreds of millions and billions of dollars currently, and my concern is there's already some shady financing deals popping into this space. I know it's not a popular opinion, but when you really analyze the financing that's going on, it's very reminiscent of previous bubbles, where this time a lot of these startup companies are leveraging Nvidia GPUs to take out financing and loans. The problem with that is pretty apparent when you consider the fact that the price of GPUs usually plummets every 2 years. Jensen Huang, who is the CEO of Nvidia, states that every 2 years, the performance of GPUs more than doubles, which means there's a never-ending arms race for the next generation of GPU. And it also means that the collateral you use to take out loans and financing, the value of that collateral is going to collapse. Now, I want to be clear, I'm not trying to be a try-hard wannabe Michael Burry here, identifying some financing risk in the system, but it does concern me a little bit. I often ask myself, okay, what is AI today that it wasn't 2 years ago? We used to call this stuff big data. What really is occurring today that wasn't around a couple of years ago? Sure, there's a few things you can point to, but overall, I think this is going to be really similar to the internet, where it's overhyped short term, valuations make no sense, bad financing goes on, but long term, the value of AI is actually underhyped because of the increased efficiencies AI is going to bring to our economy long term. Now, to rumble through the last 3 causes of recessions previously, obviously, we can point to the Great Virus Crisis when the government imposed a lockdown on the country. That caused a recession, very rare. We've also had bear markets in the stock market where revenues and profit margins and earnings and valuation multiples fell, and as a result, that caused a recession. The exception to that would be the 1987 and 2022 bear markets. But then the last reason is this melt up. It's very akin to the asset bubble, where we see a melt up in valuations and in the stock market, and eventually that leads to a meltdown when the bubble pops. And there could be a lot of different things here that cause this melt up or this asset bubble, but in my opinion, it's if the Fed cuts rates prematurely or throws money at a crisis in the system that isn't really a crisis. That crisis could be a recession that they think is coming that isn't really there. And when we look at everything I've considered in this video, our economy is healthy, our jobs market is healthy. Sure, there's pockets of our economy that are feeling pain, but a lot of them are just pockets that there's a lot of excess in, and that excess just needs to get flushed out. Our economy has proven it can operate efficiently and effectively at the federal funds rate of 5%. Why change what's working? So let's talk about the timeline of this. Obviously, when it comes to asset bubbles and market melt-ups, it is extremely hard to time the top. That's what makes the meltdowns and the bubble popping so catastrophic to investors and the economy as a whole. But in my opinion, whether it's this asset bubble or melt up that occurs that causes the stock market to go higher, or if it's the Fed put that causes the market to go higher, which again is where the Fed says they're going to cut rates to avert a recession if a crisis presents itself. And as a result of that, the markets keep going higher because their mentality is, when is the Fed going to cut rates? When's the Fed going to cut rates? The longer that takes to happen, the longer this bull market lasts. And honestly, if the Fed does cut rates, we're likely in store for some extreme short-term upside. I don't see this bear market or recession taking place until at least the second half of 2025. And that is a very unpopular opinion. You're going to go watch a YouTube video from Johnny Bravo or one of the other doomsdayers out there saying things are breaking today, and they're going to completely disagree with me. But I would encourage you to encourage them to show you real data, to go a little bit deeper like I did in today's video. And if you guys did enjoy this, please hit that like button for me and give me feedback in the comments section of how I can improve videos like this, make them more engaging. Also share with me whether you agree or disagree with me. And if you want access to additional macroeconomic analysis and breakdowns like the one in today's video, consider joining my membership down below. It's one of the cheapest ones on YouTube, but I have a 100% refund policy if you don't find value in it. I'm that confident in providing you that value. So hit the join button or hit my Patreon link in the pinned comment. With that, I hope you have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.